Rima, let's talk about the IT earnings scorecard so far.
Well, we've got three large caps which have reported numbers so far: Tech Mahindra, HCLTech and TCS. And all three have reported a beat on muted expectations. So the revenue growth first will come up for you on your screen in constant currency terms. HCLTech right on top, 2.4% revenue growth. You have Tech Mahindra at 1.6% and TCS is 0.8%. All this is better than what the street was anticipating. Margin performance too has been higher than consensus expectations, and margins for the company have actually expanded across the board. HCLTech, Tech Mahindra margins expanding by nearly 1 percentage point. Part of it is also aided on account of the rupee depreciation. The rupee depreciated by 2.5% against the dollar, and that aided. Now, in terms of commentary, there is no big change in the demand environment. All the companies are saying that it's not gotten worse, but it's not that it's gotten better. In pockets, things are fine. Like, BFSI, for instance, has been doing very well. TCS maintained that its international revenue growth this year, FY26, will be higher than FY25. HCLTech maintained the full-year revenue forecast, but for the services business, that's ex-software, they've tightened it. So they've raised the lower end of the target band. So 3 to 5% guidance became 4 to 5%. And Tech Mahindra too, yesterday in the press conference and the investor call, they reaffirmed that FY27 goalposts of industry-leading revenue growth, margin performance of 15% remains intact. So all in all, versus subdued expectations, remember the IT index itself was down 20% on a year-to-date basis. The performance wasn't too bad. But again, it doesn't imply that growth is roaring, is coming back in a big way. Sandip Agarwal, fund manager at Sowilo Investment Managers, is now joining in. Sandip, I know the broad call is that, the Indian IT companies, particularly the large caps, are not going to see any growth, not just this year, for the next couple of years. It's going to be, we are in a low growth environment for IT. But just talking about the near term and what we've seen from these companies, Persistent, etc., what would be your top 3 or 4 takeaways?
No, so, the most important takeaway in my view is that, none of these companies have gone ahead and done something wrong. That is a good thing, because in difficult times and in very good times, both the cases, generally companies and promoters do mistakes. And I think that is one thing which has not happened. So it is a very good thing they have conserved cash despite all the noise to do acquisitions and get into AI and all. This is, I think these comments which people make, probably they have not understood the industry properly. So I think the good part they have been able to do is that, like Accenture, they are continuously doing their work, and they know that it is a low growth industry, it is a mature industry, and they are not rushing and doing some mistakes. So that is the biggest positive takeaway, I think, for the industry, because there is no sense in going ahead and burning money. Second, I think versus expectation, because expectation was much weaker. Versus that, most of the companies have been able to, do slightly better in this environment where your efforts are going down dramatically. And most importantly, they realize very quickly that, the efforts are going to go down. So there is no point in adding manpower, and they have allowed natural attrition to, go away, and they have not refilled that fully. So, their at least margins have been kept under control and protected. So I think these are 3 key positive takeaways from the industry.
Got that. Sandip, the expectation was that because we are in a low growth environment, margins will come under pressure in FY26 and even in FY27. But now, considering we've got the rupee tailwind, depreciation tailwind, but even the efforts taken by the company, as you said, rightly said, right? They're letting the natural attrition play out. They are in a sort of cost conservation mode. Do you think that thesis might get challenged, that maybe the IT companies will be able to protect their margins, maybe even grow it in FY26, FY27? Is that a possibility? Because that changes the EPS estimates.
So, Rima, I am very confident of 2 calls. One, that, next 5 years, the large cap will not grow in double digit at all. That is not going to happen. Maximum growth will be mid-single digit to, high single digit. That is also very tough. But second call, which I have very contrarian call for the sector, is that I believe that in fact the margins will be protected, and I believe some uptick in margins will happen in next 2 years, because remember that when efforts are going down by 30%, you will not get revenue growth, but your realizations will definitely move up. So I am very confident on margins. I believe that margins have a tailwind, in fact, without rupee also. But yes, growth will not be there. So this is an industry which is matured, where growth will be less, but margin and EPS growth will be slightly higher. Also, EPS growth will be higher because of buybacks if that continues.
So now in the large cap IT companies, would you have a pecking order?
No, so, we run a PMS. I will not give a call on any specific company, but I will say you this, that you see the number of last 10 quarters for all the large IT companies and mid-sized IT companies, barring 3 companies, no one has reported a double-digit year-over-year revenue growth. So that gives you the answer, right? So this industry has entered a phase where it is too much matured and AI has cut down the efforts, which was the growth engine. So I think, we will be seeing this industry as a 5-6% growth industry, and some of the mid caps can do 10-11%, which are in ER&D, and then small caps can do actually 20% because the small pilots will continue for 3 to 5 years in AI, which will give very high boost to very small size companies in near term.
This HCLTech announced, reported $100 million revenue in advanced AI. What are your thoughts on that?
No, I see, obviously, every quarter you will see this number will shoot up for everyone. So there are 2 key numbers to watch in the industry. One is how many resources you are able to train month on month, quarter on quarter in AI. So that is very important because that will defend your revenues and that will also give you some growth going forward. Second is that, what is your contribution of AI in the overall revenue. I think both the numbers are very critical and very important. And I think all the Indian large companies are reporting good numbers there. I hope not much of that is reclassification of the existing business into AI and all, because see, it is very tough to segregate also. But I believe that they should say that the new business which they have got in AI, that will be more relevant. And that is something which we should look forward. If that is growing faster, then probably, this high single digit growth is also possible for the large cap, but it will take time in my view.
How should this $100 million AI revenue trend according to you? I mean, if you have to make projections, what would that number look like? Because we have, say, a comparable from Accenture, right? They've been giving it out for the last 2 years, the AI revenue. I mean, say for Indian IT companies, and we only have HCLTech for now, which is reporting this, what could the number look like, say 1 year, 2 years down the line?
So I think in next 2 years, it will be around 15% for all the players, large players.
15% of the overall revenue will come in from AI.
Yes, absolutely. At least that much, maybe more.
Maybe more. And the other IT companies, you believe, will also start disclosing this number. And what would that mean in terms of valuations? Now, because this advanced AI is seen as more of higher tech work compared to the legacy application development work that they used to do, therefore, can the analyst community or the investors make a case that these companies need to trade at higher multiples, at least for that portion of the business?
So, Rima, I think that the right way to always look at is compare with the NASDAQ companies. And in my view, there is a substantial overvaluation in the NASDAQ components. And I think when they start coming down and they come to realistic valuations, then probably, Indian IT companies will not get re-rated during that period. But I think there'll be flavor which will come back after maybe 12 months or 18 months into Indian IT services, large companies also, once that meltdown in the NASDAQ components happen. And I am very confident that, they are massively overvalued. And a lot of those companies which are today selling high-end technology in the name of high-end technology, they are actually going to be commoditized. Because basically those products are commodity. Right now, there is no competition. There is no big scale innovation which is happening. So I believe when that happens, you will see massive price correction. You can't have 60-70% margin on commodity products, right? So it has to come down. It is a matter of time. And when that happens, then, NASDAQ multiple will come down. And when that comes down, it will be very tough for us to get re-rated. That is the way I look at the sector.
Sandip, always a pleasure talking to you. Thanks a lot for stopping by, giving us your quick take. We look forward to hearing your commentary and tracking the space as well. Thanks a lot for joining in.